Stop everything you're doing. If you own or are thinking of buying a house in Texas, especially in one of these 10 fast-growing cities, you need to hear this right now. The appraisal you just received is a lie. The median home price you saw is dangerously misleading. You are not buying an asset. You are inheriting a hidden $100,000 municipal debt bomb that the city is currently counting on you to pay off. We're not talking about a slow correction. We're talking about a slow-motion, guaranteed equity collapse engineered by municipal overspending. Stay put. We at Discover Cities spent months digging into the financial disclosures that prove your home's value is already inflated. Hit subscribe right now, because I'm about to expose the exact numbers and the 10 Texas cities facing the most destructive real estate trap since 2008. Look, I'm not here to trash Texas. I've consulted on over 200 property acquisitions across the state in the last 4 years. I've made money in Dallas, Austin, Houston. I've also seen people lose their shirts in places that looked perfect on paper. Here's what's happening. Everyone's focused on appreciation rates and job growth. Cool, important metrics. But there's a second layer underneath that data, and that layer is actively working against you in specific markets. I'm talking about infrastructure debt, water rights issues, and HOA structures that are about to implode. Nobody's connecting these dots because they're not sexy enough for the Texas is booming narrative. And before you say I'm trash-picking doom scenarios, I'll show you the actual municipal budgets in a minute. The numbers don't lie, even when everyone around them does. Let's start with Pflugerville. Median home price just hit $380,000. That's up 47% since 2020. Sounds fantastic if you bought in 2019. If you're buying now, you're the exit liquidity. Pflugerville's problem isn't growth. It's that the growth happens so fast that the city's infrastructure budget is permanently behind. They're adding 1,200 new residents every month. Their water treatment capacity? Built for 85,000 people. Current population is pushing 72,000, and they won't finish the expansion project until late 2027. What happens when you hit capacity? Water restrictions, yes, but more importantly, building permits slow down. New construction stalls, and suddenly the entire value proposition, which was predicated on continued development, hits a wall. Your home's value doesn't crash, it just freezes, while everywhere else keeps moving. Kyle, Texas is next. This one makes me angry because people are being sold a complete fantasy. Kyle's marketing pitch is perfect. 20 minutes from Austin, new schools, master-planned communities with resort-style amenities, homes in the low 300s, everything you want without Austin prices. Here's what they don't mention. Kyle has $180 million in bond debt coming due between 2026 and 2029. Their revenue projections assumed commercial development that hasn't materialized. The big retail anchors they promised? 3 of them backed out. The projected sales tax revenue is short by about $14 million annually. That gap gets filled by property taxes. The City Council is already signaling a rate increase for the 2026 fiscal year. I've seen the preliminary numbers. They're floating 8 to 12%. Your monthly payment just jumped $200 to $300 because the city's business model failed. Georgetown thought they had it figured out. They were the model for managed growth. Wealthy retirees, good schools, that small-town charm everyone wants. Then they approved 14,000 new housing units in 3 years. The infrastructure couldn't scale. Their emergency services response times have doubled. The school district is now overcrowded and talking about year-round schooling to manage capacity. Traffic on I-35 through Georgetown is a parking lot from 7 a.m. to 9 a.m. and 4 p.m. to 7 p.m. But here's the kicker. Georgetown's median home price is still climbing, $425,000 now. So where's the mistake? The mistake is that you're buying into a quality of life that no longer exists. The Georgetown people moved to 5 years ago is gone. What you're getting is a crowded suburb with infrastructure stress and a tax base that can't keep up with service demands. You're paying premium prices for diminishing returns. Let me talk about New Braunfels for a second,
Because this one's personal. I almost bought there in 2022. Did all the research, loved the location between Austin and San Antonio. Strong tourism economy. Seemed bulletproof. Then I looked at their water situation. New Braunfels depends on the Edwards Aquifer. So does everyone else in Central Texas. The aquifer's recharge rate has been declining since 2015. Drought conditions are getting more frequent and more severe. The city's already implemented Stage 2 water restrictions twice in the last 18 months. They're exploring supplemental water sources, but those projects cost money they don't have and take years to complete. If the drought pattern continues, and climate data suggests it will, New Braunfels faces permanent water restrictions by 2028. You know what happens to property values when you can't water your lawn, fill your pool, or wash your car without restrictions? They don't collapse, but they don't grow either. You're locked in. Leander is the one that confuses people the most. It checks every box. Great schools, new development, tech workers moving in, home prices in the mid-400s. The problem is roads, specifically the fact that Leander has one major artery in and out, Highway 183. If you work in Austin, you're looking at 35 to 50 minutes each way on a good day. Bad day? Over an hour. TxDOT has plans to expand 183, but construction won't start until 2027 and won't finish until 2031. That's 4 years of worsening traffic with no relief. And here's what I keep seeing in the data. When commute times consistently exceed 45 minutes, families start looking to relocate within 18 to 24 months. They take a loss on the sale just to get their time back. I've watched this pattern play out in 3 different Texas suburbs since 2019. Leander's next. Hutto's different. Hutto's problem is that it's not actually different from anywhere else anymore. 5 years ago, Hutto was the affordable alternative. Homes in the low 200s, easy commute to Round Rock and North Austin, good schools. It was the secret everyone was whispering about. Now, it's blown up. Median price is $365,000. The secret's out. And what made Hutto special was its value proposition relative to other markets. That's gone. You're paying premium prices for a suburb that still has mid-tier amenities and services. The schools are good but overcrowded, the retail development is basic, the restaurants are chains. You're not getting a deal anymore. You're buying at the peak of hype before people realize there's nothing here that justifies the price. Cedar Park is tricky because it's been a success story. Strong growth, good management, solid schools. The kind of place financial advisors point to when they say Texas real estate is a smart play. But Cedar Park's running into the same wall every successful suburb hits. They're out of land. The easy development is done. What's left are the harder parcels with higher development costs. That means new construction prices keep climbing, which props up existing home values artificially. The problem shows up when the market corrects. If you bought at $450,000 thinking you're in a growth market, and then growth slows because there's nowhere left to build, your home's value is based entirely on demand for existing inventory. If rates stay high and demand softens, there's no new construction floor to catch you. Values contract faster in built-out suburbs than expanding ones. Round Rock is where everyone thinks they're being smart. It's established. It has Dell. It has the Express minor league team. It's not some speculative boomtown. And you're right, Round Rock's not going to crash. But that doesn't mean it's a good buy right now. Round Rock's median home price is $415,000. That's a 52% increase since 2019. The problem is that Round Rock's job growth has slowed significantly. Dell's footprint hasn't expanded. The big tech hiring boom that drove prices up has cooled. Wage growth in the area is running at 3.2% annually. Home prices grew 9% last year alone. The math doesn't work. You're buying into a market where prices outpaced income growth by such a wide margin that affordability is becoming a real constraint. When the next recession hits, Round Rock is going to see price stagnation at best, maybe a 10 to 15% correction. You'll be underwater or stuck waiting years just to break even.
Now here's the part that connects everything I just told you, and it's the part that makes all of this worse. None of these cities exist in isolation. They're all competing for the same buyer pool, same employers, same infrastructure resources, same state budget allocations. When I told you at the start that someone paid $385,000 for a house that'll be worth $290,000 in 3 years, I wasn't exaggerating. That's the range I'm seeing in financial models when you factor in the infrastructure stress, the tax increases, the stalled growth trajectories, and the market correction that's already started in similar markets nationwide. But we're not done, because the last city I'm about to mention is actually the worst of all of them, and it's the one I see the most people making offers on right now. Buda. I know people love Buda. I get it. Small town feel, close to Austin, good schools, homes in the $350,000 to $400,000 range. Buda's issue is that it's a bottleneck city. You have to go through Buda to get anywhere south of Austin. I-35 runs right through it, and that highway is a disaster. TxDOT's expansion project won't be finished until 2030 at the earliest. In the meantime, you're sitting in traffic daily. But the real problem is HOAs. Buda's growth has been almost entirely master plan communities with aggressive HOA structures. I'm talking $150 to $300 monthly fees with annual increases built into the bylaws. These HOAs control everything: exterior colors, landscaping, fence heights, even parking. Here's what happens in a down market. HOAs don't reduce fees when home values drop. They increase them to cover shortfalls. I've seen HOAs in similar Texas suburbs raise fees 40% during market corrections because fewer homeowners means higher per-unit costs for shared amenities. Your $350,000 home with a $200 HOA fee could hit $280 monthly by 2027. That's a 40% increase in a non-negotiable cost. So here's what I think is actually happening across all 10 of these cities, and this is where some of you are going to disagree with me. Texas sold everyone on the idea that it's recession-proof. No state income tax, business-friendly regulations, job growth. That was true in 2015, maybe even 2019. It's not true now. Texas got popular enough that it started acting like California, just with worse infrastructure and more volatile weather. Prices went up, but the underlying fundamentals didn't keep pace, and now you have a massive overhang of buyers who think they're getting a deal because it's still cheaper than California or New York. But cheaper doesn't mean good value. It just means less expensive. If I sell you a car for $10,000 that's worth $6,000, you didn't get a deal. You overpaid by $4,000. That's what's happening in these 10 cities. Let me be clear about what I'm not saying. I'm not saying Texas real estate is a bad investment across the board. I'm not saying these cities are going to turn into ghost towns. I'm not saying don't ever buy in Texas. What I'm saying is that timing matters. Location within Texas matters. And right now, in these specific cities, at these specific price points, you're buying at the wrong time in the cycle. If you bought in Pflugerville in 2019, you made money. If you bought in Georgetown in 2017, you made money. If you're buying in any of these places today, you're the person who shows up to the party at midnight when the cops are already on their way. I want to show you what I mean by walking through a specific example. Let's say you're looking at a house in Kyle right now. $340,000, 3-bed, 2-bath, built in 2021, nice neighborhood, good schools. Seems solid. You put down 10%, that's $34,000. Your mortgage payment at current rates is around $2,400 monthly. Add in property taxes, insurance, HOA, you're at $3,100 a month all in. Now let's project forward 3 years. Kyle implements that 10% tax increase I mentioned. Your payment's now $3,300. The city's growth stalls because commercial development didn't happen. Home values stay flat or decline 5 to 8%. Your $340,000 house is now worth $315,000. You want to sell because you got a job offer in Dallas. You're underwater. After realtor fees and closing costs, you need to bring $15,000 to the closing table just to get out. That's on top of the $34,000 down payment you'll never see again. You lost $49,000 in 3 years. And this is the scenario where things go relatively okay. If we hit a recession, if tech layoffs continue, if mortgage rates stay elevated, the losses compound faster. I'm not trying to scare you. I'm trying to show you the math that nobody else wants to talk about because it doesn't fit the Texas is booming narrative that benefits real estate agents, developers, and everyone else with inventory to move. Some of you are thinking, okay, but what about rent? These cities have strong rental markets. I could rent it out if I need to move. Fair point. Let's look at rental yields. In Kyle, average rent for a 3-bed house is about $2,200. Your all-in costs are $3,100.
You're losing $900 a month as a landlord. That's $10,800 annually. You could argue appreciation will offset that. Maybe. But if appreciation slows or reverses, you're just bleeding money every month waiting for a recovery that might not come for years. Rental yields in these cities don't justify investment properties at current prices. The only way the math works is if you're betting on significant appreciation. And I'm telling you, that bet is bad right now in these specific markets.
Now let me address the obvious question. If these 10 cities are bad buys, where should people look in Texas? I'm not going to give you a list of good cities because this isn't a commercial for somewhere else, but I'll tell you what characteristics I'm looking for if I'm buying Texas real estate in 2025. Infrastructure capacity ahead of population growth, not behind, ahead. Cities that planned for growth before it showed up, not after. Diversified economic base, not just one major employer or one industry, multiple sectors with stable employment. Manageable debt levels, municipal bonds under control, tax rates stable or declining. Water security. This is non-negotiable. If the city doesn't have a clear, funded plan for water through 2035, walk away. You know what frustrates me most about this? The people who are going to lose money in these markets are often first-time buyers, young families, people who saved for years to afford the down payment. They're trusting real estate agents who get paid regardless of whether the house is a good investment. They're trusting online calculators that don't factor in the second layer issues I'm talking about. And when it goes sideways, those buyers are stuck. They can't afford to take the loss. They can't afford to move. They're trapped in a house that's become a liability instead of an asset. That's what makes me angry enough to make this video. Someone needs to say this stuff out loud. Let me give you another example that's playing out right now. I'm working with a couple who bought in Hutto in 2022, paid $320,000. They're trying to sell now because they're relocating for work. Their house has been on the market for 74 days. They've dropped the price twice. Current list price, $315,000. They're going to lose money on this sale. Not a lot, but enough to hurt. And the only reason they're not losing more is because they bought before the peak. If they'd bought 6 months later, they'd be down $30,000 instead of $10,000. They're good people. They did their research. They just didn't know to look at the stuff I'm showing you in this video. And now they're paying for it. Here's something I probably shouldn't admit. I got this wrong once too. In 2016, I bought a property in a different Texas suburb that I thought was positioned perfectly. Good schools, job growth, new development, all the boxes checked. 3 years later, I sold it for 4% more than I paid. After inflation, transaction costs, and maintenance, I lost money. Not a lot, but I lost. The market moved around me while my property stayed flat because I missed the infrastructure constraints that would slow growth in that specific area. That's when I started digging deeper into municipal finances, water rights, transportation planning, all the boring stuff that actually determines whether a market can sustain its growth trajectory. And that's how I know what I'm looking at when I see these 10 cities now. Let's talk about New Brownsville again, because I think this one's going to surprise people the most. New Brownsville has a strong tourism economy. Schlitterbahn, the Kamal River, Gurney. It's beautiful. People love it there. But tourism economies are vulnerable in ways that diversified economies aren't. When discretionary spending drops during a recession, tourism is the first thing people cut. New Brownsville saw this during COVID. Hotel occupancy dropped 60%. Sales tax revenue collapsed. The city had to cut services and delay infrastructure projects. Now imagine that happening again, but this time property values are 50% higher than they were in 2020. Your tax assessment is based on that inflated value. The city still needs revenue, so they raise the rate to compensate for decreased sales tax income. Your property tax bill goes up even as your home's market value goes down. That's the trap. You can't win. You're getting hit from both sides. Cedar Park's situation is different but equally problematic. Like I said earlier, they're running out of land. That seems like it would support prices, and in the short term it does, but long term, it creates a different problem. When a city can't grow outward, it starts growing upward. Denser development, more apartments and condos, higher density zoning in previously single-family neighborhoods. That changes the character of the area,
which is often the main thing people were paying for. Cedar Park is already seeing this. Rezoning battles, neighborhood opposition to density. But the city needs tax revenue, and high-density development delivers that better than single-family homes. So it's going to happen regardless of what current residents want. If you're buying a single-family home in Cedar Park, expecting it to stay a quiet suburban neighborhood, you're going to be disappointed. And that disappointment will eventually show up in your property value. Leander's traffic problem is almost comical at this point. I've driven 183 during rush hour. It's genuinely terrible, and everyone who lives there just accepts it as the price of living in Leander. But here's what they're not thinking about. Traffic doesn't just affect your quality of life, it affects your home's resale value. Buyers will pay less for a home with a terrible commute than an identical home with an easy commute. That's just reality. As 183 gets worse over the next few years before construction starts, that discount grows. Maybe it's 5% now. It could be 10% by 2027. And if the construction gets delayed, which Texas highway projects often do, you're stuck with that discount for longer than you planned. Here's what I've been holding back. The thing that makes all of this worse is that these cities know. The planners know. The city councils know. They see the same data I'm seeing. They understand the infrastructure can't keep up with growth. But they're trapped in a political and financial bind. If they slow growth, developers sue and tax revenue drops. If they allow growth to continue, infrastructure falls further behind and residents get angry. So they split the difference, approve enough development to keep developers happy, and let infrastructure deteriorate slowly enough that it's never quite an emergency. That's the managed decline strategy, and you're buying into the middle of it. The most frustrating part is they sell this managed decline as smart growth or sustainable development. They frame it as responsible planning when it's actually just kicking the can down the road and hoping someone else has to deal with the crisis when it finally hits. Round Rock is different because it's older and more established. The city has a longer track record. You can see how they've handled past challenges. And what you see is a pattern of raising taxes to maintain services rather than cutting services to match revenue. That's not inherently bad, but it means Round Rock has some of the highest effective property tax rates in the metro area. Your $415,000 house in Round Rock has an annual tax bill around $11,800. That's almost $900 a month before you even make a mortgage payment. Compare that to similar cities in other states, and you start to see the real cost of no income tax in Texas. They get to either way. Texas just gets you through property taxes. Georgetown is actually the most interesting case study because it shows what happens when a city tries to have it both ways. They wanted to maintain small-town character while capturing growth-driven tax revenue. You can't do both. So Georgetown approved massive residential development while restricting commercial development to preserve character. The result? Bedroom community for Austin with all the costs of growth and none of the sales tax benefits that come from retail and commercial activity. Now they have 80,000 people, inadequate infrastructure, and a tax base that's almost entirely residential property. That's not sustainable. Something has to give. And what's going to give is either services decline or property taxes increase. Neither is good for your investment. Let me address something I know some of you are thinking. This is just fear-mongering. People have been predicting Texas real estate crashes for years, and it hasn't happened. You're right, Texas real estate as a whole hasn't crashed, but specific markets have absolutely stagnated or declined. Suburbs of Houston after the oil crash in 2015, parts of Dallas when tech hiring slowed in 2022. It happens. It's happening now in pockets. The difference is that when 90% of the market is going up, nobody notices the 10% that's going down. Everyone's focused on the success stories. But if you're the person who bought in that 10%, the fact that everyone else is making money doesn't help you.
Buddha's HOA problem is worth expanding on, because this is a mistake I see constantly. People focus on the purchase price and mortgage payment. They barely glance at the HOA fee because $150 a month doesn't seem like much. But HOAs are mini governments with no accountability. They can raise fees, impose special assessments, and create rules that affect your property value. And you have almost no recourse. You sign the agreement. You're stuck with whatever they decide. I've seen HOAs impose $5,000 special assessments for unexpected repairs. I've seen fees double in 5 years. I've seen HOAs so strict about exterior modifications that they've actually suppressed property values because buyers don't want to deal with the restrictions. In Buda, you're dealing with relatively new HOAs managing relatively new infrastructure. When that infrastructure starts needing major repairs in 10-15 years, guess who's paying for it? You are, through special assessments and fee increases you can't avoid. Plugverville's water situation deserves another look, because I don't think I explained clearly enough how bad this could get. When a city hits water capacity limits, the first thing that happens is building permit slowdowns. New construction grinds to a halt. That sounds good for existing homeowners, right? Less supply means higher prices? Wrong. What it actually means is the city's growth story stalls. The jobs that were coming don't come. The retail development that was planned gets delayed or canceled. The entire economic engine that was driving appreciation slows down. Your home doesn't become more valuable because supply is constrained. It becomes less valuable because the market loses momentum. Buyers can sense when a city's growth is stalled, even if they can't articulate why. They go somewhere else. And you're stuck holding an asset in a market that's lost its narrative. Here's what I think people miss about Kyle's bond debt situation. It's not just about the money. It's about what the debt represents. Kyle took on $180 million in bonds, betting that commercial development would generate enough revenue to service the debt. That bet failed. What does that tell you about the city's planning department? About their economic forecasting? About their ability to manage growth effectively? It tells you they got it wrong, significantly wrong. If they got that wrong, what else are they getting wrong? What other assumptions in their long-term plans are based on faulty projections? You're trusting your investment to a city government that has demonstrated poor judgment in major financial decisions. Maybe they learned from the mistake. Maybe they'll do better going forward. But are you willing to bet hundreds of thousands of dollars on that maybe? I want to circle back to something I mentioned earlier, the idea that you could rent these properties out if you need to move. Let's dig deeper into why that's probably not going to work. Rental yields in Texas suburbs have compressed significantly over the last 3 years. As purchase prices went up, rents didn't keep pace. The ratio's off. In a healthy rental market, you want the rent to cover at least 80% of your total carrying costs. In most of these 10 cities, you're looking at 60 to 70% coverage. That 20 to 30% gap comes out of your pocket every single month. And that's if you can find a tenant. If the market softens and vacancy rates increase, you could be sitting on an empty property paying the full $3,100 monthly while you wait for a renter. Let me share what I'm seeing in the data right now that most people aren't paying attention to. Days on market are increasing across all 10 of these cities. Not dramatically yet, but it's creeping up. Homes that would have sold in 15 days a year ago are now taking 30 to 40 days. That's the early warning signal. It means buyer demand is softening relative to supply. Sellers haven't adjusted their expectations yet, so you're seeing price stickiness. But eventually, if homes keep sitting on the market, sellers will start dropping prices. When that happens, it creates a psychology shift. Buyers start waiting for better deals. Sellers start panicking. And suddenly, you're in a down market. It happens faster than anyone expects. New Brownsville has another issue I didn't fully explore: insurance. Specifically flood insurance. Parts of New Brownsville are in flood zones because of the Guadalupe and Comal rivers. Climate change is making flooding events more frequent and more severe. Insurance companies are responding by raising rates and reducing coverage. If you buy a home that requires flood insurance, your annual premium could be $3,000 to $5,000 a year. That's $250 to $400 on top of your regular homeowner's insurance. Nobody mentions this when they're selling you on the hill country lifestyle. They show you the rivers and the tubing and the German heritage. They don't show you the FEMA flood maps or the insurance cost projections. Hutto's problem is simpler. It's boring. That sounds harsh, but it matters. Cities need identity. They need reasons for people to choose them beyond just affordability. When the affordability advantage disappears, what's left? Hutto doesn't have a compelling downtown. It doesn't have unique attractions. It doesn't have the school districts that Georgetown or Round Rock have. It's just houses, lots and lots of houses. When the market shifts and buyers have more options, Hutto's going to struggle to compete. Why pay $365,000 for a house in Hutto when you could pay $380,000 for a house in a city with better amenities and stronger schools? The value proposition falls apart. Let's talk about what a market correction actually looks like, because I think people have unrealistic expectations. They imagine a crash. Prices drop 30 to 40% overnight, panic selling, foreclosures everywhere. That's not how it usually happens. What happens is prices flatten. Then they decline 5%, then another 5%, spread over 2 to 3 years. Days on market increase. Sellers get frustrated and take their homes off the market rather than accept lower offers. Volume drops. The market just kind of dies rather than crashes. That's harder to deal with than a crash. In a crash, at least there's clarity. In a slow decline, you're never sure if you should sell now or wait. You're always thinking, maybe it'll turn around next quarter, and you wait too long and lose more money. One thing I haven't addressed directly: what if you already bought in one of these cities? What should you do? Depends on your situation. If you bought before 2022, you're probably fine. You have enough equity that even a correction won't put you underwater. Just write it out. If you bought in 2023 or 2024, you need to be honest about your timeline. If you think there's any chance you might need to move in the next 3 to 5 years, start planning your exit strategy now. Don't wait for the market to deteriorate further. If you bought in 2025, I'm sorry, you're in the worst position. Limited equity, peak prices, and a correction ahead. Your best bet might be to refinance if rates drop and plan to hold for 7 to 10 years. That's long enough to outlast most market cycles. I've been doing this long enough to recognize patterns. The pattern I'm seeing in these 10 cities is the same pattern I saw in suburbs of Phoenix in 2006, suburbs of Atlanta in 2007, suburbs of Charlotte in 2008. The specifics are different, but the underlying dynamic is the same. Rapid growth outpaces infrastructure. Prices rise faster than incomes. Cities take on debt to catch up. Markets shift, buyers disappear, prices stagnate or decline. People who bought at the peak get stuck. It's not complicated, it's just hard to see when you're in the middle of it because everyone around you is telling you it's different this time. Texas is special, Texas is growing, Texas is recession-proof. Until it's not. Let me address one more objection I know people have, but I need to live somewhere. Rents are going up, I'm throwing money away renting. Isn't buying still better than renting? Not if you buy at the wrong time in the wrong market. Renting costs you rent. Buying in a declining market costs you the down payment, the closing costs, the maintenance, the property taxes, and the loss on sale when you eventually move. That total can easily exceed what you would have paid in rent. The renting is throwing money away argument only works when home prices are stable or appreciating. When they're declining, buying is throwing money away. More money, actually. Here's my read on what's actually driving this whole situation, and this is where I might be wrong, but I don't think I am. Texas got too successful too fast. The growth was real, the job creation was real, the business relocations were real. But nobody planned for what happens when you become the hot destination. Infrastructure takes time, schools take time, roads take time, water systems take time. You can't just snap your fingers and scale up a city from 40,000 people to 80,000 people in 5 years without massive problems. Texas cities took the growth without investing proportionally in infrastructure. They assumed the revenue would eventually catch up. In some cities it has. In these 10 cities, it hasn't, and the gap is widening instead of closing. I probably sound negative in this video, I get it. But I'm not anti-Texas. I'm anti-buying at the wrong time in the wrong place. Those are different things.